Everyone, welcome to another episode of Line Your Own Pocket. So last time we talked a little bit about, getting started with a small account and ways to potentially get funded and setting expectations and things like that. I think today we're going to talk a little bit more about just the nitty gritty of, some potential benefits and workarounds and how you would trade a small account. And because we're doing these kind of back to back, we haven't seen the feedback of the first one yet, but keep those coming because I do think this will be kind of a hot topic and we would love to get your feedback. And then maybe, down the road, we'll revisit it again a little more.
Yeah, I think this is it's a good topic that, at first I thought, okay, well, I have to think back really far back to when I was just starting out. But a lot of the topics are timeless, no matter how big your account is, because you're learning skills, trading skills that apply really no matter how big your account is, and the better you get at that, the better you are as a trader. So
Well, and I thought the same thing too. And I started to think of, because I look down and I see the size of my account, and hopefully I know that I'm nowhere near $25,000 and I don't have to worry about that for the rest of my life now. But I started to think about it on an individual strategy basis. And I think this is something that will be interesting to talk about where the next strategy I employ, I'm not giving it my whole account right off the bat.
yeah.
It's so we can start to kind of put ourselves in that role and think about kind of anytime you take a strategy live, you should almost pretend you're in a small account right off the bat because you should only be giving it access to a certain aspect of your account.
Yeah, I think that's totally true. I mean, the other thing I think people assume is that, okay, once they have a big enough account, like it's all easy street or
Yeah.
like it's a whole different world and it's just a lot easier. But it doesn't really get easier. It just you just have different sets of problems. Maybe
Yeah.
you have more flexibility, but you're still everything you learn from even those early stages is cumulative, and you will continue to apply those skills throughout your whole career. So, and I think you're totally right. When you come up with a new strategy, yeah, you're not applying your whole account to it. It's like
Right.
I think that's a great way to put it and a great way to think about it.
Well, so that's why I want to talk a little bit about. I did have some examples, and I won't name any names, but I've been following this one gentleman on Twitter, who, with it kind of made his account and made his wealth through shorting kind of these low float penny names that have been going crazy, and over the last year or so, there's been a handful of widowmakers with these, like companies that have gotten halted for 6 months plus. If you're in them, your money's just gone until whatever happens. There's been a couple companies that have gone up 10,000% in a day, and things not managed correctly. And this is another systematic trader that does this. And I've seen actually a couple of these mentioned where the idea is that he's kind of looking at his account now and saying, "This is how I got here." But do I need to be here anymore? Do I need to be risking this entire account that I've built up that's now, and he's public about it, many, I think it's over $500,000 or so on these particular strategies? Or do I retire them entirely, or now I kind of trade a subset of the account? And that got me thinking about kind of where I wanted to talk about in this podcast about how there's, like you mentioned, there's kind of levels to it, and there might be a place that makes the most sense to start when you have a smaller account. And then as you kind of build out strategies, you're building on top of a building as opposed to going in different directions. And I think that's kind of an interesting way to start. Is so imagine you're this person that we talked about last time, and you've got 5 grand, but let's say the pattern day trader rule doesn't apply to you, right? For whatever reason, you're in another country, you're in Canada with me, or like we talked about, they're starting to diminish that. That's your first account. The way I kind of look at that, and the way I'm going to ask you about, is I'm way more open to taking significant risks with that account as opposed to, instead of $5,000, $500,000 or $5 million or whatever the account ends up being later.
Yeah. So I think your point from last week about how uh, the if you're going to make mistakes, make them earlier. I
Yeah.
think that applies here. And that's why it doesn't get quote unquote easier when you get a larger account because the money you're risking is a lot more. So
Right.
the mistakes can be even worse. And maybe you have more wealth. Maybe you can afford to absorb a bigger loss, but still there's phases you go through where you have to kind of acclimate to the sizing. You can't just like all of a sudden, you win the lottery, you've got a bunch of money, and then all of a sudden, you think about money differently. You're still gonna have periods where like you make some mistakes that you used to make at smaller sizes precisely because your size is higher now. Like you're gonna, oh, my old friend of overtrading is back, or
Yeah.
you kind of go through these cycles where you're up at a different size, and all of a sudden the psychological issues are like some mistakes you used to make at a smaller size that you thought you got rid of have reared their ugly head again.
Well, and that's why I'm so interested in this kind of starting point, right? And I think all people, I'd say 90% of them, when they start with that small account, they look at it and they kind of intellectually know there's no way you're going to make a living with the $5,000 account. But, they hear the stories and a lot of them are fake, but some of them are legitimate. Like, the Kualamari, whatever, who turned 10 grand into 80 million or something at this point. So these things can be done, and they kind of hold on to those, but it instantly starts with a incredibly high risk kind of mentality of kind of because again, that, okay, for me to make anything out of $5,000, I have to double it over and over and over and over again. And to do so, the only way to do that is to take pretty explosive risk. But I think that's not necessarily a bad thing as long as you're not going, you're not blowing it up and going too crazy or gambling mode with it, because it kind of acclimates you a little bit to the kinds of styles of trading that can work for small accounts, which are more illiquid, lower float, smaller cap stocks. And then, well, first of all, do you agree? And then the way I look at it is that a lot of people look at it as I'm going to then graduate from this. And what I think might make more sense, and what we talk about all the time, and the benefit of systematic trading, is that maybe you get to a point where, like I mentioned with this one trader, where these things are just too wild for trading a $500,000 account. But why not continue to trade $10, $20, $30,000 or whatever you were doing before there, and then take your other $300,000-$400,000 and do a different set of strategies that hopefully are somewhat uncorrelated to that, and kind of build out from there. So basically, I guess I'm giving permission to the small account people to go a little bit nuts in the beginning.
Well, to be able to do that, you have to be able to allocate money that you literally don't need.
Right.
Like if it goes to zero, that you have to be totally fine with that. Now, when you get to that point, and you're going to be at such an advantage to having that mindset, because you'll have your mindset's completely different if you need the money. If you don't
Right.
need it, then you can take risks. You actually have a much clearer mind about things when you don't need the money. So, that it's.
But I guess I'm also kind of making an assumption too, that I think in most cases would be fair, but maybe some cases aren't fair. That if you are starting out with $5,000, you're probably also relatively young as well. I don't think there's a lot of 50, 60, 70-year-olds, entering the game now. I guess they could just say, I'm just only going to allocate this amount of money to my trading, and that'd be responsible of them. But I think I'm just kind of assuming that if you are also in the small account world, then you're probably also in the younger side of things as well. And I think a lot of those things kind of go hand in hand with risk-taking appetite.
Sure.
I'm thinking of myself more in my early 20s, where I didn't have much money, but at the same time, I also didn't have kids and a house and a wife and all that stuff as well.
And also, time is on your side when you're younger. Like you can
Yeah.
make mistakes. You got plenty of time to recover if there's, if you ruin your account or whatever. So, the stakes get higher as you get older. Um, the other thing I was thinking about this is, you know, last week I said that there are a lot of strategies that bigger players couldn't even consider that you could with a smaller account. And I think that's definitely true, but there's a big but there. There's a bit of a chicken and an egg problem where to be able to trade some of these smaller strategies well, you have to have developed some good trading intuition and some skills to be able to make some of those trades with smaller liquidity names that it requires some finesse. And you may not have those skills as a new trader. You're only going to develop those skills the more experience you get. So there's a bit of a chicken and an egg problem there that I think you run into.
Yeah, because I've heard that before where they say, well, I have a small account so I can trade lower liquidity things. But you're right. You're probably also a newer trader and you may not understand things like bid ask spread and putting limits out in the market and how much they have to sit there and things like that. And looking at things like unrealized losses and not panicking too much because the spread's just really wide. So it's showing you something that might not be legitimate. And then again, also patience. I would say, the person with the $5,000 account that's trying to really balloon it up into a lot, they might not have the patience to put out a bid to get out of a short on a liquid name and know that it has to sit there all day, right? The chances of getting filled are that kind of thing. So I'm definitely with you that the same problems seem to always remain. It's, and I've noticed this myself, is my whole thing is over trading and revenge trading. Like I think it's everyone's thing, but it's certainly my thing. And then as my account grew, it was just more of the same. It was more of and then the swings just kind of got bigger. And that's one of the reasons I went more systematic and automated. But I think the main thing and the main thing to focus on is that as your account gets larger, you're either trading the same strategies that you're currently trading bigger, or something that we talk about all the time, and I'm a huge component of, is just trading more strategies as well. So I look at it as that you should start with one and then know that strategy, the goal isn't to infinitely scale it to oblivion, but it's to take that one strategy and have that get you to some milestone. And then when you have kind of the free capital, as opposed to just scaling it up over and over again, it's implementing that other strategy. So that's why I think even a smaller account becomes harder, is because that one strategy you pick, because you don't have the luxury of trading 5 or 6 or 20 different strategies. That one strategy you pick that's going to take up all your buying power, you've got to make sure that that's the best one that you have access to at the time.
Yeah, for sure. I mean, it gets a lot easier to, like I said so many times, scale wide versus scale up. So there's a couple of things that you reminded me of as you were talking there. One is, as I traded my very first strategy, I had the R multiple concept down pat. And it's just such an important concept to have, precisely because as your account grows, you can still normalize your performance across your, back when your account was small versus now when you're trading it a lot bigger. Your performance could be normalized across that entire period. So it's just a very powerful way to look at your performance across time, precisely because of that. And I still see this in use now. I mean, a lot of traders that I work with will, when they size up, they have difficulty because the swings get, of course, larger when you look at it in pure P&L terms. Mm-hmm. And that can be, it doesn't matter even how much money it is. It could be psychologically really difficult to see your P&L bouncing around, maybe even dropping below zero, but the strategy is working, and it's very clear to see that when you look at an equity curve in terms of R multiples,
Yeah.
because that's normalized over your sizing. So it's really a very powerful, not only data tool, but a psychological tool to say, okay, no, I can see, I know what my P&L is doing. Let me look at this R multiple. I can tell that the strategy is working as designed. Like I'm just going to continue the course, and I know what the outcome's going to be here.
Well, and that's, we had a whole video about kind of hiding your P&L, and that's a big point of it as well, is that it is much easier to stomach large percentage swings with a small account. If you got 10 grand and you're up or down like a grand in a month, right? That's easier, again, assuming that, you have a job and you're working, whatever. But you're right. It's very, then all of a sudden, say you have $100,000 account. Well, a $10,000 swing up or down might be harder to stomach. $1 million account, $100,000 swing might be harder, especially because, regardless of the size of your account, for most of us traders, it's the majority of our net worth. So, percentage moves make a pretty big deal. And that's why it's so important, I think, to hide these numbers the best you can and just focus on our multiple. Because, we're talking about often, the young person starting out, but the other example I gave is the old post person who's maybe, he's put 10 grand into his account and it's doing okay. And then he, puts another 90,000 in to put to 100,000. Well, you're right. It's very possible that the next trade, his P&L actually goes negative, but the strategy is still doing fantastic. So having that zoomed out, normalized look, could look at it because maybe the next trade loses 5 grand, but still it's still a great strategy. So having these tools in place, I think it's the perfect time to do it is when you have a small account. So you have just some sort of spreadsheet or recording mechanism that doesn't really focus on the absolute value of the trades. It's just saying this is the R that you made on every single trade, so that regardless of the size of your account, it's just a line number somewhere that you're just changing and moving on.
Yeah, so it's really, this reminds me of Real Test, and I think I can't remember if it's the default, but at least I know a lot of people in Real Test will do position sizing based on the account, and in their back test, with a good strategy, the account's growing over time. So the more recent trades have a lot bigger size, so they're compounding.
Yep.
You need to turn that off when you're optimizing in the cruncher, and that's the first thing I tell Real Test users. But it's a really good visualization to see exactly the phenomenon we're talking about, because when you look at an equity curve, it's really clear to recognize when compounding is turned on, because like it's this tiny movement for the first half of the chart, and then all of a sudden the moves are really big, and like, well, yeah, that makes sense because you're compounding your account. And if you're not careful when you optimize based on that, you're just, everything before a certain date is just going to be meaningless. All the optimization is going to come from the more recent stuff, and that's not really what you want to do.
Well, and it's also important too. It's why a lot of like technical analysts, just for market charts, but also for equity curves, if you're not using like logarithmic charts, you're doing it wrong, right? It's a faux pas in the technical analysis community if you bring up like a 30-year chart of the S&P 500 and it's not log, because just like you said, it looks stupid, and people will bring up like, look, the market's got a pullback. It's ripping all the time. It's like, yeah, but it's right. It's not law. It's not a log chart. It's an arithmetic chart. So it just looks dumb. So definitely 100%. Right. Do, mess with the compounding. I think that's something for another day, because I'd be interested to see, I leave it on in some respects just because I want the more recent data to be weighted more. But again, that's a topic for another day. But
we could probably do a whole topic around that.
But the moment every night, because every now and then I'm looking at Real Test and I hit L, which is the key to do it, and the log turns off. And I do that because you have to look at it and say, because there's one thing to look and say, oh, it's only, the max drawdown on this is like 20%. That's great. And then you hit the L button to turn off the log, and you see, well, at some point that $1 million account, drew down $250,000-300,000, and is that going to be okay, right? Are you going to be okay kind of sitting there in that, losing that amount of money and coming in every day to hit that? So it really comes down to what we were talking about, that these problems are just different over time. Give me a $5,000 account, I'll stomach a 50% drawdown and not blink an eye, because where I am in my life. Give me a $1 million account and a 50% drawdown, and I just probably would not be able to continue to function through that, to be honest.
Yeah. All right. So there's a couple other things I want to touch on here. One is a mistake I made years ago, which opened my eyes to what we were talking about before about, trading skills, order types, what makes sense, when you would use certain order types. And it was extremely clear to me in one moment with one trade why this certain order type was very valuable. So let me just take you back. I started off trading a strategy that I still trade to this day. I trade a gap strategy that, stocks that are gapping up or gapping down, wait for a certain range, and then I put orders in, and I'm waiting for the stock to break the range. So if it's in the range,
so we're talking stop limit versus stop loss. Is that
exactly
immediately what it went?
I was using, so for the first many years trading the strategy, I only used a stop order for entry. I always used a stop order for exit, but there was a stop order for entry, right? So if it broke the range, that's when I wanted to get in. If it didn't break the range, I wasn't interested in the trade. So many years I did this. The stop would activate. Yeah, I knew about slippage. I would get some slippage every now and then.
Most times.
Big deal.
Most times a little slippage. Most times.
Yeah. So over time, I was growing my size, trading this thing bigger and bigger. And then all of a sudden I had this one trade. It was a short trade. I don't remember the symbol name. Pretty tight range. I was like, okay, I can lever up on this one because that's the way the system worked. And I look down, and all of a sudden, I'm down like 10R in this trade. And I'm like, what the heck happened here? Well, it was right in that moment where I realized, okay, I understand now why a stop limit order would be useful here. And that's because the stop worked as designed, but I didn't get a fill until like 10R beyond my entry. And then, of course, the stock went right back up and I got stopped out. So I had a 10R loss in like less than 10 seconds. And I was like, what the heck just happened here? Well, a stop limit, I learned really quickly, okay, here's what a stop limit does. Here's why you would want to use it. This is the exact situation because I wouldn't have got a fill or I've got a partial fill, and then the rest of it would have got filled back at that reasonable level, and it would have been just a normal loss. So that's one of those lessons that, a lot of people don't understand what stop limit orders are, but it became really clear in this instant why you would want to use one in this specific situation where you'd want to use one.
Well, and it's funny. I immediately recognized it, not because I'm a savant, just because I've done the same thing. And there's some of these, I think, battle wounds that you just have to take at some point, right? And, someone can sit down and tell you, it's like, not to compare new traders to my 3-year-old, but like, I don't know how many times I'm like, don't do that, you're going to hurt yourself. And then I just hear a scream from another room like 20 minutes later, and I just go in, like, you did the thing I just told you not to do. And it's the same where anyone can tell you, yes, use a stop limit, it'll protect you. And I think if the person immediately started to listen, what would happen is they would immediately notice the other drawdown with stop limits, which is sometimes you just won't get filled or partial filled or whatever. And then eventually, after getting nagged enough about that, they might, change it and say, I'm going to use it as a stop market until they get hit. on the other side and just realize which is worse, right? Not getting the trade that turned out to be amazing, or getting the trade that just, completely kind of ruined the statistics of the system over for the next month or so while it makes money back out. And this is why, again, I think a lot of what we've been doing in these two episodes is just encouraging people to don't let the small account be an excuse, right? We talked about in the beginning about use most of the money to get the proper tools and start testing and building and automating and mentors and things like that. But then also in this episode, I think we're permitting a little bit of YOLOing, because I would much rather the guy with the $5,000 account, or like we talked about, that opened the prop firm account for $120 to get slapped like that, than the person who puts $500,000 into trading and takes a 10-hour loss, because the mental weight of that is going to just be way harder to recover from.
Yeah.
Maybe you'll learn the lesson faster, I guess, but I still wouldn't wish that on anyone.
Yeah, so it reminds me of, so I listened to this podcast called Econ Talk. It doesn't have anything to do with trading, but it's about economics. It's a guy that does it. He's been doing it for years. His name is Russ Roberts. He talks about his dad and when he was growing up. And so at some point, there was a regulation that came along that said porches have to have railings up. It was a code to say, okay, you have to have railings up on porches because kids could just go and, they would maybe fall off the edge, right, and get hurt. It's like, yeah, his dad was like, this is a terrible idea. The railings are literally preventing kids from learning a very valuable lesson on their own. Yeah. And it's a much better approach to actually have some danger involved, not too much, but a moderate amount of danger, so that they can learn these lessons. So I think there is, like when you were saying, sometimes people just have to learn themselves. That's totally true. Like, it doesn't matter how many times I had heard that, or like, to experience it yourself is really when you really learn it, because it's very crystal clear why. Yeah.
Well, and it's one of those, hopefully, right, it's touching the stove and you don't do it again. And, back for the example for my kids, moments like that remind me of just what you're talking about. It's like, I got to let this guy take more risk. I just got to make sure it's not permanent, right? Yeah. Risk, right? And it should be the same with your trading, is that you should allow yourself to do these experiments, just not with a game-ending amount of money, which is why, in the beginning of this, I said I always want to put myself in that example of doing things with a small account. And it's why we talk about, some people just skip the paper trading part of this entirely. I do, myself. But it just means that I take that money and I just trade it smaller. So you should always kind of be, even if you're an experienced trader with a large account listening to this, take yourself back to that small account sometimes with new strategies and say, okay, I'm going to pretend I only have 10 grand in the account, and I'm going to trade the account or trade the new strategy with that. So when you're learning lessons, like we were talking about, you learn them small, you take your hit and move on, because, well, and I have a perfect example. I'm actually implementing the first swing trading strategy that I've ever done without a stop loss. And Dave probably just cried a little bit inside, which means I will be holding stocks overnight without a stop loss. And part of me wants to open up a separate account in Interactive Brokers and put 10 grand into it and just do that, because I've tested it back 35 years and it has one large drawdown of like 30%, and that was COVID. And the rest of the time, the drawdown's like 10 or 15. So it looks like it's amazing. And this is you can find the videos on my channel, but it's I think it's Larry Williams who made this strategy in like the 70s, and it's an RSI strategy that's still working today. But I haven't done it before, so it's like I'm kind of giving myself that freedom. I just want to do it with a smaller account, and to keep the rails on myself, so that if another COVID comes along and I get slapped, then I know what's going to happen, and then scale it up slowly over time, and just giving myself that freedom to experiment while keeping myself comfortable with what's going on.
Yeah, well, I love that you're doing that, because that goes right against the conventional wisdom of gurus and traders you hear.
Yeah.
So yeah, and I think that's great. I mean, it's great that you're experimenting. I think that's a great idea. Yeah, it'll. I think that's the path to unlock ways that you uniquely can trade the markets, and ultimately that's how you get really good, is to come up with a unique perspective that literally only you trade, and exploit that. And that's, that's how you get good. That's also, traders hear that and are like, wow, gosh, how can I do something that's completely unique? How am I going to come up with that idea?
Mm-hmm.
But it's actually not that hard. It's not nearly as hard as people think. And I've got a couple examples of this. One is the strategy I was trading that I mentioned, gaps, and then looking for a pullback and a tightening range in the first half hour. I am 100% certain that I was the foremost expert on that strategy during that period, because I just knew there was nobody else that had spent as much time looking at this strategy, watching them. Like, there's just no way. So I was, I think, the preeminent expert on it. And it wasn't that hard. Like, that's just all I thought about for a decade, pretty much. And it's not, I call these strategies that are trading strategies that are hiding in plain sight. A lot of traders would look at them and think there's nothing there, but it's not that hard for any trader to come up with a unique set of trades that they make from a given idea. And I see this all the time with traders who use the cruncher. So I have, and you've gone through it. There's an AFL course I provide. There's a sample strategy in there, basically an opening range breakout. Lots of traders use this as a starting point, and they come up with very interesting variations of this strategy that they go live with. And every trader that I work with that has started from this point, they'll come to me and say, hey, Dave, what do you think about this variation of it? Nobody's even close to the same set of trades. Like every, they're using the same starting point. Every single strategy or trader has a unique strategy that they end up with, even with the same starting point. So it's not hard to be completely unique in what you're doing.
Well, and I think it has to do with kind of following your niche. And this is a perfect example from, we're probably like, 2 years ago or so. Dave came to me with the idea of this podcast, and I'm like, that's going to be pretty niche. I don't know if that's going to be, I'm like, it'll be fun. I like talking to Dave. We'll see what happens. But instantly my brain was, that's too niche of an audience to really get any kind of traction. Then I've been blown away with it from there, and it kind of re-taught me that niche isn't a bad thing, right? It's like, we're never going to be like the next, like what Mr. Beast or whoever the big one is that appeals to everyone. But it's like what you're talking about. If somebody has a very niche point of view of the market, that should be your kind of fuel to say, well, I can trade pretty generic strategies just with my own little twist on them that become interesting to me. Like you mentioned, the opening range break. I look at that as the same as for swing traders and investors, the turtle trading strategy, which is just buying a stock when it breaks, end period highs. But it's all the other stuff that makes it interesting. So maybe you're someone, for example, who's really understand biotechs. You're like, well, I'm going to buy breakouts in biotech stocks, but I'm going to know that they probably matter if they're between, I don't know, phase 2 or phase 3 trials or something like that. So then you're taking a pretty bog standard strategy and you're just applying a little bit of a twist to it. And like you mentioned, you're just really focused on that area or that style of the market. And yeah, eventually you'll do great. So it's just taking, the actual act of or the ins and outs of entries and exits. At the end of the day, you're either buying a stock going up or you're buying a stock going down, right? That doesn't have to be too unique. It's just all the other stuff contained within a strategy that become interesting.
Yeah, I mean, a lot of people trade the same strategy, but the ones that do better are the ones that have a better process for figuring out which trades to take and which trades to skip. I mean, that's just the simple way to look at it. And um, especially when you have a smaller account, that's something that you can do and you can get good at, and you can become the world's preeminent expert on a certain aspect of the market. There's no question about it. And that's something that will pay off now, but it's going to pay off the rest of your trading career. Like you said, when I came to you with this idea for the podcast, I think one of the things you said was, yeah, okay, we'll probably run out of ideas pretty quickly, though. I was like, I don't think so. I think there are more ideas that will.
Yeah,
I don't think we'll ever get to all the ideas that we have for the topics here.
Well, I think we came up with one idea while we were doing this podcast, and I think in the green room before we got started, we already came up with the idea of what to do next week. And none of those are on the dock. That seems to just be infinitely growing. So you're right. And it all kind of comes from like one starting point. So just to kind of summarize, I think what we've talked about with, in these 2 episodes with a small account is, the step one is just the, understanding that you aren't going to turn, or very likely aren't going to turn 5,000 into $100 million, at least not very quickly, right? So whatever you start with, you've got to be 100% okay with just that's what it is to learn or to lose. We talked about, prop firms and ways to maybe augment that a little bit, but it is what it is. But yeah, I think this episode has just been more about use this as a time to have a little fun, build some, get that first strategy really running and really comfortable. And like we were talking about with ideas for this pod, is that one strategy and becoming an expert in that will likely just start to naturally branch off on its own, right? You'll start to see things about that one strategy that, maybe the failures are an interesting counter trend, or while that one strategy is starting to work, you're seeing other things happen that become the second strategy, or, so a breakout strategy. But while you're looking at the charts, you also get an idea for a mean reverting aspect of it as well. And, all of that just happens if you just start. I think that's the biggest thing, is to, get in there.
Yeah, I think start, but then also give yourself plenty of rope. Like, if you set a goal that, okay, next week I got to have this, I got to have something live, it's just not going to work. It's another level of pressure. So just give yourself plenty of time. And part of that is not needing the money, and just, you have to have faith that you're sort of like we've on this podcast that, there's this fear, maybe we'll run out of ideas. Maybe we will, but I don't think that's the case. Like, as long as you're thinking about it, and you're doing it on a daily basis, you're not going to run out of ideas, and you're going to find way more ideas that you can't even imagine that you're going to come up with now. So just give yourself plenty of rope, work on your process more than, staring at your P&L every day.
Yeah, and again, I think that's the biggest thing, is that you have that freedom. I think that's actually probably a lot easier when you're a new trader with a small account, is you shouldn't be expecting to, pay for your life or anything like that. So that should actually give you a little bit of freedom to say, okay, here's the amount of money I have. I don't expect, I don't expect the 5,000 to become 5 million anytime this month or this year or in numbers of years. So that should just give me more of a freedom to, I guess, play is kind of, I guess, what I'm encouraging, is just, if the line is going up, and it's going up in a consistent way, regardless of what that is, then it's just eventually, like we talked about, outside money, prop firms or whatever, or just continuing to add your own money to it as it goes. And if you're focused on just the line going up, which again should be easier when it's not your, the way that you feed your family, then that's great. And then you're spending the whole time in the process and playing and building the skills and the processes together, that eventually you're just going to wake up one day and that 5,000 is going to be $100,000 account or a $500,000 account or whatever it is. And then you can just kind of naturally make the flip of, this has been outpacing what I've been normally doing for some time. Maybe I allocate some more time to it. I don't think it should be like a forced thing, like you mentioned, or a timeline. It should just, right, I've been able to do this for a period of time that I'm comfortable, and away I go.
Yeah, I totally agree. Well, yeah, I think this has been a good couple episodes.
Yeah, and this is one again. We don't have feedback from the first one to this one yet, but we're going to get this feedback, and like we mentioned, we always read the comments. So if there's areas of this that you want us to go over, budget friendly options for data or back testing or places to start, for different areas, certainly let us know. But yeah, it was a cool one, and again, we've come up with topics in this one, so you'll hear a lot of those soon. And as always, I'm Michael Noss.
And I'm Dave Mabe. Talk to you next week on Line Your Own Pockets.